you are organizing your finances. 2, you must spend less than you earn. When you earn maybe 50,000 naira per month, you must not spend all that 50,000 naira. You must spend less. Like you spend 20,000, 25,000, 30,000. But when you are spending all your earning, it will be hazardous because you will not have any reserve. So earning minus spending will give you savings. Savings will lead you to investment. Investment will bring returns to you. And once the returns is given to you, growth will come in. The next one is that put your money to work. And idle money is a useless money. Your money must put to work. Your money must be working, must not be idle. When your money is working, it will give you a multiplier effect. You are growing. Everything around you will be growing. Another step is that you must limit your debt to income. Your debt is your liability. Must not be equal to your income. If your debt and your income is the same thing, automatically you are generating liability. And the principle of finance is that you must produce assets. So limit debt to income, that is, produce assets. The next thing is the continuously educate yourself. According to Piaget, in his principle of education, he says a teacher must always be student. Once a teacher stops to be a student, such a teacher should resign. And learning starts from birth to death. So, to fulfill the principle of that financial management, that is why we are in the class today, listening to finance management lecture. Another step is understand risk. As a human being, you must know that risk exists. Risk is the worst scenario that can happen to anybody, to any organization, to individual, to the company, even to the formation houses. There is risk everywhere. Any person, any organization who are shunned from risk cannot grow. Individual that start from risk cannot grow. Even Esther in the Bible did not shine from risk when she was not entitled to see king. She took that risk. The higher the risk is the higher the return. If you are stagnant, you are shunned away from risk, there's no moving forward. Another step in the basic principle of finance is diversification, which is not just for investment, but for profit. We are not diversifying for just diversification. We are diversifying for investment. And after investment is to make profit. That is, the purpose of establishing any business is to make business. Is to make profit. Not ordinary profit, to maximize it. And lastly, under principle, basic principle, is that we need to maximize our employment benefits. The salary, the wages, gratuity, pension we are earning need to be maximized, must not be idle. Now, it will lead us to another topic, which is principle of financial transactions management. Every organization, they have policies and procedures of handling transactions. Our formation analysis, our seminaries are not excluded from these policies and procedures. What are we to follow in handling transactions on behalf of our seminaries or formation houses? One, consistency. Transactions must be handled in a consistent manner. That is, policies and procedures have been established to address similar types of transactions in a routine manner. For example, now, here we have school and building project is on. So there must be laid down rules how to receive money for this project, how to spend this money, and how to report the money we have spent on this project. These are the policies and procedures we are talking about. If the school have been built before, they must have policies and procedures in spending. So as we are building schools today, that policies and procedures in which the authorities have established must be followed to letter. Here we are not using our common senses in handling things. We follow policy and procedures. Two, there must be timeliness. Transactions must not be handled endlessly. It must be handled within a reasonable period of time, consistent with time frame routine. So, when we are handling our transactions on behalf of seminary or information houses, there must be time frame. It must not be endless. There must be justification for our spending, for our transactions. There must be reason for the transaction that support project goals and adhere to guidelines outlined by the formation houses. When you are handling transaction, you must ask yourself, is there reason? Is this leading to the desired goal? So if they are to achieve the desired goal, it's a reasonable transaction. But if it is against the desired goal which have been set up, it's not justified. So the next step is documentation. This area we normally have problem because the people we are dealing with, for example, let's say for example, building project, we will make use of bricklayer. We will pay them. Electrician will come. We will pay them. Plumber will work for us. We will pay them. Majority of these people, they don't have receipts. How are we going to document the money we spent? It's no problem. We need to make an improvised document. The name of the person, the type of work he has done, the amount we have paid him, and signature. So we will file it. So that is documentation. And that documentation must be able to stand for audit. Because auditor, you cannot sit down in front of the auditor and be explaining to him, I spent this so much for bricklayer, I spent so much for electrician, I spent so much for a plumber. He must peruse something that truly you have carried out that job and truly it has been certified. So that is for documentation. And lastly, there must be certification. Certification, that is, transactions must be approved and carry all the correct authorizing signatories. Because A tree cannot make a forest. If you are in position of authority to execute that project, you must have an higher officer who will authorize to carry out that project. There may be one, there may be two, there may be three. Before carrying any transactions, the signatures of these people must be on your paper as approval. And in spending too, you are not only officers that is there. You have higher officers too, who are above you, who are to tender their signatures as approval of what you are doing. Try to collect their signatures in order to obtain their authority to approval. The next one is budget. You see, every Victor Manari are making budget or executing budget. But if you are not a finance manager or expert, you may not know that you are preparing budget. Imagine those community that are working in the kitchen. They will go to the market to buy foodstuff, which will be used in the seminaries or formation houses. Before going to, after giving money to them, they don't go to the market just like that. They will take their pen and biro. They will list it. What am I going to buy with this money? Rice. How many bag? How much will it cost me? Beans. How many bag? How much will it cost? Basket of pepper. How much will it cost? Basket of tomato. How much will it cost? A packet of Maggi. Until they finish that money abstractly. On getting to that, what they are writing down is budgeting. They are preparing budget. But what they have written down may not be the same thing when they get to the market. The price might frustrate or go up, or the price may come down. But at the end of the day, they will compare what they have written as budget with the actual price they get in the market. What are they doing? They are doing budgeting. They are preparing budgeting. They are executing budgeting. Likewise, an individual, community, seminaries, formation houses, and our government, they are not excluded from preparing budget. Everybody is preparing budget, knowingly or unknowingly. Therefore, budget is the process of forecasting revenue and expenses towards achieving certain goal. What are the steps to create budget? 1. Calculate your net income. The foundation of effective budget is your net income. If you are considering your gross income and preparing your budget, you will miss it. Your take home is what you will plan on. 2. Track your spending. As you are spending, you'll be tracking them. Then 3, set realistic goal. You see, we are not preparing that budget for just preparation's sake. You must aim at achieving something. So set a goal that will be realistic. Then make a plan. And next thing is adjust your spending to stay on budget. Then review your budget regularly. Calculate your net income. Foundation of effective budget is a net income. That is your take-home pay. That is your total wages or salary minus deduction for taxes, pension, cooperative, health insurance scheme, etc. If you are not a regular pay worker, that is you are self-employed, make sure you keep detailed notes or record of your contracts and pay in order to help you manage your irregular income. As I've explained, your net income you'll be reckoning with while preparing budget. B, track your spending. Once you know how much money you have coming in, the next step is to figure out where it's going. Tracking and categorizing your expenses can help you determine what you are spending the most money on and where it might be easiest to save. Begin by listing your fixed expenses. We have fixed expenses, and variable expenses. Fixed expenses, they are the expenses that are regular, like rent. It's not fluctuating. If you are paying 20,000 naira per month on rent, it will be 20,000 naira throughout that year. So it's a fixed expenses. Or mortgage. If you have taken loan from the government, or you buy house from the government, and you are repaying for that house, the amount they are deducting every month is fixed. It's fixed. So if you buy car and you are repaying it, you are repaying the money, it's fixed. If you are paying 50,000 naira or 20,000 naira per month for repayment, it's fixed. So that's the fixed expenses. The next, apart from the fixed expenses, is variable expenses. The variable one is the one that fluctuates. It can go up, it can go down. So this is an area where you might find opportunity to cut in order to be in the budget line. Record your daily spending with your pen and Bible. Don't believe in your brain. Believe in your pen and Bible. You may record on your smartphone. We call a paper spreading budget. This is the spreadsheet we are recording or tracking our spendings. The next step is set realistic goal. Goal will be set up to be achieved within a period of time. We are preparing budget for the purpose of achieving the goal we have set. The goal you have set may be to build school, to improve the quality of food given to the students. The goal may be buying of furniture for the seminaries or formation houses, or building in the seminaries. So these are the goals that we are preparing budgets on. Set a realistic goal. You may, if you set a bogus goal, you are just joking. the budget you have prepared will be useless because what you want to achieve is not realizable. The goal you must set must be the goal you must achieve within a limited period of time between the time frame attached to that budget. For example, if you are a salary earner, earning 100,000 naira per month as your take home, and you are planning in a short time of between 1 to 3 years to build a mansion, is it a realizable goal? You can't achieve it. So that's not a real. But if you want to buy a car within 3 months, within 3 years, at least if you are saving 50,000 naira for 3 years, we buy you. If you cannot buy a new car, at least a fairly used car. So that's achievable goal. Set a realistic goal. Now, the next step is make a plan. This plan is what we call budget itself. Your income, your expenses, this is where it will enter. So the budget you are preparing is your income, your expenses will enter. So what you are actually spending versus what you want to spend. Use variable and fixed expenses. You compile to get a sense of what you will spend in the coming months. Then compare that to your net income and priorities. Consider setting specific and realistic spending limits for each category of expenses. You must choose to break down expenses even further between things you need to have and things you want to have. For instance, if you drive to work every day, fuel counts as a need. You cannot drive your car without fueling it. So it's a need, it's not want. A monthly GoTV fee subscription, however, may be counted as want. If you don't desire to watch it, you may not even subscribe to it. The difference becomes important when you are looking for ways to redirect money to your financial goal. The explanation of this is that we have fixed expenses, variable expenses. If there's need to readjust your spending, you will start from variable, because if you are paying to landlord because you want to adjust your spending, you cannot reduce its rental fee. But what is variable is what you will start cutting. I've prepared an example of a budget, and I will be explaining from this. This is a budget for 12 months. Revenue is 10 million. Cost of sales, 7,500,000. The aim and objective is to achieve gross commission of 2,500,000. Now, we have administrative expenses like salaries and wages, transport, traveling, and some other things. Who believe that cost of sales of this 7,500,000 is fixed expenses? The more you reduce it, the more the revenue reduces. The more you increase it, the more the revenue increases. But administrative expenses, they are variables. For example, salaries and wages and other benefits, they can be adjusted. Anybody, you see, this is for salaries and wages. At times, if you absent from duty, authority may pardon you and pay you full. But if they want to be strict, they will not pay you all. It's pay as you work. So transport and traveling, we may reduce the amount we are spending for transport and traveling. It's variable. We may decide not to go to where we want to go. Audit fee, we may decide to carry out audit, or we may decide not to carry it if authority will not query us. Then repairs and maintenance, we may decide to reduce all this. The more we reduce these expenses, the more our net profit is increasing, is pushing up. So that is for variables and fixed expenses. Then review your budget regularly. When you set up the budget, like I've explained, the kitchen staff that go to the market. So at the end of the day, you will compare what you prepare before going to the market to what happened actually. So at times, what you have spent on the item may be reduced. At times, it may be increased. But at the end of the day, you will balance up with the quantum of the money given you to spend on that project or event. So that is for budget. Examples are here, and then later we pass it to you. This leads us to revenue and expenses account. You see, in our seminaries and formation analysis and seminaries are established not to make profits. They are like charitable organizations. They are improving the life of people. They are changing life of people to better, or for better. So our seminaries and formation analysis are not different from all these. They are non-profit organizations. For example, now, as non-profit organization, if you want to report of our activities, one of the accounts we can prepare, they call it revenue and expenses account or revenue and expenditure account. This is a replica of profit and loss account in profit-making organization. They are replica of profit and loss of a profit-making organization. This account, if we prepare T form of it, that is, we prepare T form of it, revenue will be credited, expenses will be debited. All the expenses, irrespective of whether it's capital or variable expenses, will be debited in that account. And revenue, which is it may be donation, it may be grants, it may be anything, will be credited. At the end of the day, in a profit-making organization, we will get profit or loss at the end of the day, but in revenue and expenditure account, because we are non-profit organization, what we will get is excess or deficit. Hope are we moving forward? Okay. So this is the account prepared by non-profit organizations such as schools, churches, formation houses. Revenue and expenditure account show the use of funds they have received and the allocations of the fund. If income received is more than expenses incurred, then it is called excess. Like I've told you, if the money we receive, either for a project, we spend less, the balance remain unspent, we call it excess. But if we spend more than what has been allocated to us, the difference between the money they have given to us and the one we have spent, we call it deficit. So if income received is more than expenses incurred, then it is called excess. And if expenses are more than income, it is called deficit. A balance sheet in profit-making organization is the same thing as balance sheet of non-profit organization. So the balance sheet prepared by the company is the one in our formation analysis of seminary we prepare too, because we have, as a company, they have building, we have building too in our formation houses. As they have a motor vehicles, we have motor vehicles in our formation houses too. So as they ask the creditor, debtors, cash in hand, cash at bank, we have it too in our formation houses. So the balance sheet is the same thing. Only the difference is where the profit-making organization, we write retained profit or excess profit or accumulated profit. But ours, instead of writing retained profit, we will not write retained profits, we write accumulated excess or accumulated deficit. That's the only difference area. For school, it's the same thing. It's non-profit organization. Receive revenue and expenditure account will be prepared. Formation houses, we are not making profits. Revenue and expenditure account is required. So, in preparation of revenue and expenditure account, if there is rule, there is policy and procedures, if a money is given to you as a building project, you can't spend it in any other area than for building project. If it's given to you for the provision of food, good food, you can't spend it for the buying of chairs or payment of salary. You spend it solely for the provision of food. So, but if it is general, you can use it anyhow. You can use it to pay salary. You can use it to improve the facilities in your school or in your seminary. What are the advantages of revenue and expenditure account? It separates specific purpose fund from general purpose fund. The money allocated for improvement of food cannot be used for the acquisitions of furniture or assets. It cannot be used for the payment of salary. So it segregate or separate specific purpose fund from general purpose fund. It separates fund depending on the purpose of the fund provided by law or the donor when given a grant. You see, grant will be given, but they will attach it to something. If it is attached to a specific thing, the money must be spent on specific thing. And when you are given report, so it must be on that specific thing which have been approved for. It requires preparing a receipt and payment account, showing how much you have collected in the year or specific period, or how much you have paid in a particular period, and how much amount still remain in a fund. This will still lead us to another account in the line of reporting. But before we go, we are talking in the principle of basic principle of finance management. We made mention of cash flow projection. You see, it's a twin system with budget. When you need money or fund for the project, the authority may ask you, what are you going to use the money for? Prove to us that the money you want to collect will be utilized. What they are asking you is cash flow projection. What should we do? is to prepare a cash flow projection for them. The cash flow projection will tell you, we show revenue, expenses, then the net flow. That net flow will help the authority when examining your cash flow that, okay, let's take for example for hospital, if we are running hospital management. So the little money we are collecting from the patent and on drugs will be our revenue. Our expenses will be salary we are paying to our doctors and the nurses. At the end of the day, is the money coming in compared with the money we spent? The balance, is it surplus or deficit? If it is surplus, okay, it will encourage the authority to approve the expansion of the project. But if we are recording loss, so when they examine your cash flow, they will let us spend in this project. In future, we may come back to it, but now this is not friendly. So that's the work of cash flow. It will help authority to know whether to approve for you the expansions of your project or not to approve it. So example is here, you will see it later. It will lead us to another topic, which is receipt and payment account.
Can we go on break now?
Let me finish. Let us finish it today.
We'll go on break so that when we come back, we'll finish like 5 minutes.
So let us go on break and later we'll come back.
Brother Paul, I hope you are listening. Now your budget, when we know they are approved, you see why now.
I'm communicating. Yeah.
Water.
Thank you.